Now, before I start this week's show, I'd just like to say a quick thank you to our podcast sponsor, Fidelity International. Now, Fidelity are one of the best known investment platforms out there, and they're also a global fund manager responsible for around £320 billion worth of investments for over 2 million clients globally. Now, I personally use Fidelity's investment platform to run my own 80/20 investment portfolio, and that's for a couple of reasons. A, because they're cost effective, and B, because they have access to ETFs, investment trusts and unit trusts. For those of you out there who are looking for ideas of where to invest your ISA allowance this season, then Fidelity offer a range of guidance and fund shortlists, and they also offer fund suggestions from their investment director Tom Stevenson, whose name you may recognise because he also writes for The Telegraph. Now, you can find out more information about Fidelity and all of those fund shortlists at fidelity.co.uk. But for now, on with this week's show.
Hello and welcome to episode 206 of the Money to the Masses podcast with your resident expert. Finally, Damien Fay and me, Andy Leeks. Damien, we're back after an extended Christmas break. What happened?
We are, and I've been really buzzing to do this because obviously we had the Christmas break, which was a natural pause we told everybody about, and then we were due to come back last week and I lost my voice, and it was a combination, I think, of a cold, too many football matches, sort of shouting and frustration at Spurs, who knows. But what ended up happening is, I lost my voice, and we kept trying to do it, didn't we, Andy? We kept trying. At the last minute, I had to just give in. But everybody got a dose of me anyway this week by the new podcast that came out, Damien's Midweek Markets podcast that we'd promised before Christmas and was launched this week. So that's what happened. Yeah,
I enjoyed editing that, and it's refreshing. I mean, I love being on a podcast and I love editing podcasts. It's what I do. It's why I'm coming, not why I'm coming over, but it's part of the reason I'm really excited to be working at Money to the Masses in the coming weeks. And anyone who missed that, we made that announcement just before Christmas that I'm taking a step over to be working with Damien full time, and I absolutely cannot wait. But it was quite refreshing to be working on a podcast that I'm not a part of, because obviously I'm hearing that for the first time, so I'm almost hearing it like a listener does, and that's nice actually. When you're editing, it's nice to be able to listen to it fresh, and so you don't come with any preconceptions. And actually, I learned a lot too. So thank you, Damien. I enjoyed that.
Well, what was good about it is because it was the first time you'd heard the podcast when you edited it. And therefore, you always want to get feedback, because you do these things, you don't know how they're going to work. And it's like we did this podcast and everything we've done with Money to the Masses. And of course, you're the first person to feedback. And Andy, despite what you might think, Andy isn't going to just say he thinks it's good. Andy is very honest about things, if things do and don't work. And of course, Andy said he liked it. And then I got a lot of good feedback on Instagram and Twitter. Go and look at the social media channels, and you'll hear and see what people said about the podcast. That's been great. So any feedback or any topics you want covered, listen to that podcast. We're going to be doing it every Wednesday, and I'm going to be giving you updates on the markets.
And do feedback to Damien as well, and submit your questions over, because really you can be a part of that podcast. That's the whole idea. It's to be a very interactive weekly podcast where you can answer your questions and your concerns. And I'm right in saying, Damien, aren't I? You really want that to be a sort of almost like a conversational thing. You want people to be emailing in and getting there on Twitter and answering their questions.
Yeah, and just to prove how interactive these things are, today's podcast is going to have a lot of interaction from listeners, because quite a chunk of it is derived from listener questions, because we've had a bit of a break, so they've piled up some really good ones around investing generally, because we're going to still cover investing on a more general, less contemporary basis, evergreen basis on this podcast. And obviously I'm going to say a quick hello to as many of you I could do, but one of them in particular, Sharina Devon, wrote in the last couple of weeks and said she's listened to, I think, almost our back catalogue now, Andy. And she said we send her to sleep almost every night, and she meant that she meant that in a very positive way, she said. But good to hear that we're providing a public service of sending people off to sleep, even with money.
Excellent stuff.
So less of the chat, I suppose. We get on with the money stuff.
Yeah, what have we got on this week's pod?
So as I said, there's a lot of listener interaction on this week. So we've got some pieces on momentum investing and value investing. We've had questions about whether it works, how it works, etc. in this environment, because we're in a market that is very volatile at the moment. So some good questions surrounding that. We're going to look at ways to make money. It's a new year, new you and all that jazz. So we're going to look at ways that you can make a few extra pounds. And there is another piece that's going to lead on to, which is to do with trading allowance. And it's something some people might not realise that everybody has, but you have something called a trading allowance. So we're going to touch upon that as well. And if we get time, there's going to be a little bit about retirement income and what I might do in a certain scenario. Again, another listener question.
Excellent. So what are we going to start with?
Let's start with the investment piece because it's very timely, and I'm going to read out the part of these questions. So the first one came from Phil. I won't give Phil's surname in case he doesn't want me to, and it says, "Hi again, Damien. I hope you're well. I've been thinking about momentum investing and current market volatility. Could you please explain to listeners how this strategy works and are there different types? Also, if momentum picks climbing funds, would a diversified momentum portfolio be counterproductive? Thanks, Phil." Now, momentum investing, if you don't know, it basically rides a trend. So that trend is up or down. So you, in a positive environment, what you would want to do is you would be trying to buy what is already winning, what is going up. So you're going to ride something that is increasing in value. Could be a share, could be a fund, and you'll jump on that bandwagon. So let's think about last year. 2018 is a good example. Momentum worked brilliantly in the first part of, well, let's say the summer of 2018, but in the last 9 years we've had this bull market that's been buoyed by central banks pumping money into the world and cutting interest rates. There's been a momentum drive. You buy things that are going up, regardless of what they were, you were probably going to make money. And so that trend riding means you don't necessarily have to be bogged down into the company's accounts, the fundamentals of why a company is doing well, whether it will do well in the future, what its past results might mean for the future, and any unfolding consumer trends or tax breaks or political environment. You can just try and look at what's going up. And momentum investing is something that I use on 80/20 Investor, which is our DIY investment service. And you can use it to try and speed up the investment decision process. Now, it doesn't mean you're going to get everyone right. It just means that you've got a greater chance or likelihood of picking tomorrow's winner by basing it on short-term performance metrics. That doesn't guarantee, like I say, you're going to necessarily win tomorrow, but momentum investing has been proven over the last 100 years by various different bits of research to work over the longer term. And that includes the other three styles were smaller companies investing and value investing. Smaller companies meaning you buy small companies, the shares of small companies because they might be tomorrow's Apple, giant companies, and therefore their price explode upwards, or value, which we're going to come on to later, which is basically you buy things because they are cheap and unloved, and those companies suddenly become loved because you either take a educated guess that they are going to be, or you might look at something that you see value in what they're doing and the market is underpricing or undervaluing that, so you get in early and then the market realises you are a genius and the company is brilliant and they jump in value. That's what Warren Buffett, that's what he does. So going back to the question, how it works, momentum, is you pick those trends that are rising. Of course, what can happen, which is what we had in October, when that momentum turns and flips on its head because there's a sudden change in the macro environment, the background, or everybody becomes risk averse, then momentum could be downwards as well. So you can get it where the market will accelerate to the downside and those things that went up will fall down. So it's almost the quicker they rise, the quicker they'll fall. And if you keep chasing momentum, there can be a point where you can get caught as that changes. Now, Phil asks, are there different types of momentum? Well, there are. They're all based around fundamentally, usually performance, so recent performance. And of course, we have our own algorithm which takes into account other risk factors. So you can do variations upon it. And you can, if you wanted to, create your own, or there are different funds out there that do it. But yeah, fundamentally they come down to following trends that are already running rather than trying to second guess the future. So Phil asked the question whether if you diversify a portfolio, is that sort of counterintuitive really? Is there any point? So what Phil means by that, if you think you're buying stocks, so you're buying shares and they're going up. Let's just talk about them generally. If they're rising and you're thinking this is brilliant, so everything's going up, why would you diversify into a portfolio that holds other types of assets? Because if the momentum's with those assets, why would you bother with the ones that aren't doing so well, or in fact are going in the opposite direction? The answer is because of diversification. It's to manage risk. Because what you saw happen in 2018, which is a good lesson, is that as everybody concentrated more and more from global stocks into American stocks, because actually they were kind of the last man standing when it came to markets. All other markets crashed around February last year, and they've never really recovered to their highs again. And in most cases, including in Europe, that they started to go into bear markets, they effectively just kept falling throughout the year, interspersed with nice rallies along the way, but never really hit higher highs. They were hitting lower highs, which is symptomatic of a downtrend. So what happened is that people kept seeing, well, US stocks are holding up, we'll go and buy US stocks. So everybody started funneling into American stocks out of all the other global markets. But even so, within that market, tech stocks were flying, and so people started concentrating more and more, not just in American stocks, but into tech stocks. You get a concentrated trade. So when you get a mass consensus like that, it's vulnerable for a reversal at some point. And we talked about it all the way through the back end of last year, and it did eventually occur. It was kind of inevitable. You just don't know when. So if you diversify, you limit that impact, because if you'd just been in tech stocks, then you would have had a sizable impact, and you could have seen your portfolio fall 20% in a matter of weeks. Whereas if you've been in bonds as well, then they ended up rallying because people moved into safety and went for things like bonds, or they went for defensive stocks. So they went for stocks that weren't exposed so much to the economic cycle. They went for things that would be maybe tobacco companies or medicines, because they know that people buy these things regardless of whether there's a recession or whether the economic outlook is pretty poor. We all need medicines. Smokers still will buy tobacco. So what we do at 80/20 Investor is that we look across the whole range and don't just focus on one type of asset. So a brilliant example is what's happened to my 50k portfolio. When the market turned in October, it obviously was following the momentum up. And so when it turned, it did underperform with that initial stage in that first week or so, because it was following the momentum up. But then as I changed my portfolio, because of the momentum started to be positive in defensive assets and bonds, for example, and even cash, I started moving more and more into those areas. And what happened is that the market seemed to go sideways for much of November, but then we had another stronger, more aggressive down leg in stock markets, which peaked or bottomed on Christmas Eve. And if anybody had seen that, it was an absolute carnage. The market just plummeted. But of course, I'd moved out of stocks, and actually I was only exposed to between 30 and 40% of my portfolio in equities, down from about 60 to 70% prior to that, before the autumn. And so it meant that my portfolio didn't fall. And in fact, I was shorting part of European equities, because the momentum got with actually shorting stocks, i.e. betting on they would fall. So you do tend to get a form of momentum appearing somewhere. Now, as the sell-off carried on, we got to the point with 80/20 Investor, there were hardly any opportunities out there that had any momentum, because it was all going bandy. So you end up limiting what you can buy. You end up holding more and more cash, which is what I've done. So the diversifying element doesn't mean just because you follow momentum that you can't still diversify. You still should, based on your own risk profile. But naturally, if you start looking at beyond just one asset class and looking at other assets, you'll start to move and shift towards what is in favour. And at the moment, it's going to be the more defensive stuff and bonds. So my portfolio holds more. Of course, we may get an explosion to the upside, in which case my portfolio at the moment would then underperform for a period until I flipped across when the momentum picked up, because you're not going to get the initial blast, you're going to get the momentum over time. It will shift in towards more equities once the trend builds, and I'm happy with that. In an ideal world, you'd like to capture the bottom and miss the drops from the tops, but that's not going to happen. So if you can capture most of the upside and limit the downside, you're going to do well. It's about getting more right than you do wrong. And what we've seen is that over Christmas, I was talking to my brother, Justin, who works at Money to the Masses as well, and we're looking at what's going on in the stock market, and said, bizarrely, the more this market collapses, the more my portfolio outperforms relatively to everybody else.
Yeah.
Of course, I was losing a bit of money, a couple of percent here and there, but because I was more defensive, then all those trackers or those funds where, don't forget, fund managers don't tend to aggressively move into cash. they don't, because they've got to invest. That's what they're paid to do, and they don't market time. We don't want to market time. We're not trying to do that, but it's just following, where's momentum? Is it here? Is it there? And you just go to where it is. So a very good question from Phil. There is an element where you think it can be counterproductive, but what it does do, diversifying manages risk. And it's all about managing risk rather than just going for gung-ho. Because if you enter a bear market, then the general trend is going to be downwards. And you can get into a case where you're just changing your portfolios too much, trying to chase the trend, and you actually just don't get anything.
Excellent stuff. Well, it seems to be, lots of questions on investing, especially with what happened over, leading up to Christmas. And you mentioned it just there. There's also the other point. People have been asking about the other side of things, the value investing. So you had a question on that?
Yeah, I mean, this one came from Chris, and he said he acknowledges the way that there's different types of investing, say momentum, which 80/20 does have a focus on, although 80/20 investor has all sorts of research pieces that aren't just based on momentum. But he says his personality tends to favour a more value-based approach. And he said apart from the obvious slight knocking in seeing his portfolio going down over 10% in the sell-off recently, he's starting to relish the good deals in the UK that are starting to appear. So there's some good yields being produced on big blue chip companies. And he was wondering if I could say a little bit about the difference between momentum and value based around this. What Phil actually highlights there is quite interesting about his preference. Now, investing, there is no one way that's going to always outperform. And when we talked about the three ways that have been shown to outperform over the long term, which was the small caps investing, value investing, and momentum, they won't all work at the same time or outperform the other all of the time. Every dog has its day, and even if you wanted an investment style that was based around throwing darts into a dartboard to choose the funds or shares that you wanted, there'll be evidence to show that that will outperform at some point. And some of it's down to personality. Some people just want to be able to invest and forget, so they might want to favour a tracker. Some people might want to try and get their hands dirty and try and outperform the market, or invest in line with their ethics or the way they view the best way to invest. So in this case, it'd be value. Now, value means that you're going to try and find those unloved gems and dig them up, and they're going to turn into something amazing. You're going to realise they're going to have some value. Now, in an environment that we've had in the last 9 years, growth has tended to outperform value. And the reason is because growth-based investing has almost mirrored momentum. Growth stocks tend to be those companies that don't necessarily pay dividends as such. The focus is on building a company for the future sale price or the earnings in the future. And that tends to be things like tech, because obviously the tech companies run at huge losses for a long time, and then their product becomes universally used, and therefore they are able to make a lot of profit. So you think of things like Facebook and Apple, they could be classed as growth stocks. But of course that ended up being a real momentum trade because people favoured that. Value hasn't done so well in the recent past, but when the market sold off, value started to pick up versus growth, because people then started to look for, we want to look for the fundamentals, which companies actually are priced because they have got a good outlook. There is actually, the people want their products, they're well run, and stocks that in the future were actually going to lift and rise in value based on that fundamental, rather than just the fact because the price is going up or everybody's buying them. And that was why value started to outperform. And it's quite an interesting indicator when you start seeing that happening, because it means people are focusing more on fundamentals rather than trends. And if people focus on fundamentals, then when share prices got very lofty as they had done, then that's always that Wile E. Coyote moment, when he goes over the cliff and he looks down and he pulls that funny face and then he suddenly drops. That is where you get that value investing starts to outperform growth. You might get one of those moments and the stock market falls, and we kind of had that back in the autumn. So value investing it's one of those, it's been shown to work in the long term, but it is very difficult to do, because you've got to look at the fundamentals of a company, look at their profit and loss, look at all their accounts, and you've got to discover why that company is undervalued, and why the market has got it wrong, and why you know any different. And there are lots of things called value traps you get, where somebody goes, this company's undervalued, and they put a lot of money in it and it's unloved, and then the share price falls even more. The history is littered with those. And so Warren Buffett has been really good at picking value companies and actually making money, but he's also had a lot of companies where he's thought there was some value in them, and he's lost a lot of money. He did it with Tesco's. Recently he lost, I forget how many billion on Apple, and now Apple you'd think would be growth orientated, but he saw value in it, so therefore it was on a valuation basis he bought into it. But Warren Buffett is a billionaire. You have to hold these things for a long time, as he did with things like Coca-Cola. Like I said, no one strategy will outperform all of the time, but it's interesting to see how they interact, and one of those interactions is seeing how different sectors perform. And it, like Chris mentions, property, is there value in those areas? And of course, with property, one of the things we've got is Brexit. So you've got to look at whether there's value in the property sector, and I'm not sure whether there is or not, because you've got to think with what's going on with Brexit. There are a lot of people who are thinking commercial property is going to have a massive headwind, because if we do exit and it's a messy no deal, then what may happen is that companies pull out of the UK, and as accordingly there could be a flood of false selling in commercial property, which will obviously drive down prices. So there is value there. And of course, Chris mentioned something that's interesting about yield. So if you buy something cheaply and you get a good income from it, so a dividend, then your yield is high. If you're going to hold it for the long term and just take that income, then of course that can be a good investment, and you don't worry so much about the capital value. So there are some interesting opportunities that fund managers are starting to look at and nibble at. If you're into that, then there are definitely opportunities there, but you're going to have a lot of volatility and be comfortable with that. In terms of technology, some people have started to look at that and say there's some value there, because obviously the valuations in some cases have dropped 20, 30, 40%. Don't forget that some of the big tech names in the world have dropped by those numbers. So we're looking at things like Facebook. So people are starting thinking, do they offer value? So there is definitely value out there. I can't go through every sector, partly because it would take too long and partly because I don't know the valuations of every sector. But if you go out and look at some of the funds out there and what they're buying, some of the value funds, and look at some of the names they hold, then that is an interesting way to start seeing where they see valuations and where they see the value that lies in the UK in particular. And I just want to quickly finish on one point, Andy. He said, what are the predictive powers of low valuations? Now, it's interesting because based on value alone, the market should mean revert. That's what if they're efficient, that's what it should do. So if you're thinking think of it like house prices. If you thought in the street, the house price, if the price of people start selling their houses, putting the house price too high, then no one's going to buy them, and the price will start to drop. So the value will fall. Equally, if the prices were low, they will start to increase. They tend to revert to what the actual value of the property is. That's the kind of idea. Even with shares and things like that, you'd hope there'd be some sort of mean reversion. It doesn't always hold, though. And so just because something is overvalued, it doesn't mean that the price will fall. Because US equities have been overvalued, for example, based on price to earnings. So the price you'll pay to future earnings or past earnings for ages, and the market there's been calls for the market to collapse for, we're talking, most of the last 9 years. And the thing is, the market can be detached from fundamentals for a very, very, very long time, and a lot of that is down to things that central banks do in terms of money printing and in terms of low interest rates. So you think the world we're in, interest rates should be at around 5%. That's where they historically live. So your mortgage rate should be around there. But no, most people haven't seen a mortgage rate like that for, well, decades. And no, most people who've bought a mortgage in the last 10 years won't have done, certainly. And so because the market is not back to where the historical norm is, there is these distortions. It means that valuations in lots of different assets can be distorted too. And so the valuations at the moment in markets may suggest that when things are overvalued, they should crash. Equally, if they're undervalued, does it mean they will go up? And it doesn't. You have to have a lot of patience if you're playing the valuation game, is the message. So yeah, valuations are an indicator where things may revert to in the long term, but it doesn't necessarily mean it's going to happen today, tomorrow, the next month, the next year, or even the next 5 years.
Okay, Damien, good stuff. Moves us on to the piece that we talked about earlier, how to make money.
Yeah, I mean, this is one of those pieces that was inspired really by bits and pieces you see this time of year. If you didn't realise, personal finance sections in newspapers are very contrived. What they do is journalists decide they want to go on holiday at Christmas, quite understandably, so they write all the content prior to Christmas. So all the stuff leading up to Christmas will be things that are around reviews of the previous year. So investments, it could be reviews of the best things that happen, the best apps and stuff like that, and trends. What you get in the new year is everybody, new year, new you. So it's all about your New Year's resolutions, how you're going to sort your finances out, how you're going to do various different things in terms of like gyms and all that. So one of them that comes up is how you're going to make more money. So I forget who did this piece. It might have been somebody like Which went through and did a whole bunch of best ways to make money. And I thought I'd rattle through some of these because for listeners, there are just reminders really. None of it is revolutionary, but there are reminders for people like, yeah, do you know what? I should have done that. So I'm going to kick off with the first one, which is switch your current account. So there are lots of people who are making offers for switching current accounts. First Direct were renowned for it, but they changed how they do it. So now, rather than get £100 for switching, you end up getting the equivalent in things like headphones or products. So they offer incentives for you to change your current account. People like Halifax give you £135 for switching. You'll get your initial switch, which is £50, and then you get £85 once you've been there for 6 months. There are a couple of others. HSBC do something similar. So if you're looking for some quick cash, if you're bored of your bank account, you can switch and get cash incentives. I've named a couple there. Always watch the T's and C's because a number of them will say you've got to move a certain amount of money each month or so many direct debits to actually qualify. Cashback. Do you use cashback, Andy? And when I say cashback, I mean when you're shopping online. I mean, I'm terrible. I never do. But do you?
No, I don't really use cashback sites. I do have a cashback facility on my bank. You can select certain companies, and if then you go and spend money with them, they'll give you cash back the following month if you make a purchase. So I think there's Costa and various different sort of high street chains. If you spend money, you get, I think I've earned about 50 quid in the last year or something. So I kind of do, but don't, if you know what I mean.
Yeah, I don't use them and people swear by them. And I mean, if there's listeners out there who have such huge success stories using them, please get in touch and me and Andy will share your experience and expertise. But things like Quidco and Top Cashback are sites that often you hear bandied around about being able to make some money if you're going to buy things. Moving on from that, shop around on savings rates. I mean, you get 2/5 of nothing, let's be frank. You might as well shop around on your savings rates. And actually, there are some interesting services out there. Hargreaves Lansdowne have a cash service where you can switch between a Best Buy table. It's their table, so it doesn't include the whole of the market, but it's a useful service where you can, if you're feeling lazy about it, it's the next step down from shopping around yourself. You can use their service to just jump between different accounts with a click of a button without any paperwork, etc. So that might be something useful where you can get some decent savings rate. I've looked at them and some of them are some of the better rates out there on the market widely, but they're not all. But there's another one, Raisin. Go and have a look at moneytothemasses.com. We did a review of it. I can't remember if I mentioned before, but it's a service that does something very similar, but it's not attached to Hargreaves. It's a separate new entity called Raisin that's been out in Europe, is now in the UK. Of course, you can do things like rent your room out. Don't forget you can make £7,500 a year tax-free via the Rent a Room scheme if you want a lodger. All these things are just kind of obvious statements. Sell some of your assets if you want to. Sell all your stuff and live in a house with nothing in it and you'll be richer, but probably less happy. One of the things I wanted to mention on that, and this is really going to bring the podcast to a close really, because there's something that most people won't realise. They get a trading allowance. Now, if you start selling your stuff, everybody is entitled to something called a trading allowance, and it's £1,000 allowance, which basically allows you to have a side hustle. I don't like that word, but you have a side thing where you're trying to make some money. It may be selling stuff on eBay, but you can make £1,000 a year without having to declare it on a tax return and pay tax on it. So everybody gets that. And it leads on quite nicely because I got asked a question by somebody.
I didn't actually know that, Damien.
Yeah, and this is relevant because I had an email from Omar and he said, I discovered your podcast about 8 months ago and have been an avid listener since. Thank you for what you're doing. I'm sure you hear this all the time, but it's really, very good. Omar, you can never send enough of those emails in, not for mine and Andy's ego, but it's also very motivating for us to keep doing what we do. Because I often get a lot of flack on Twitter and stuff like that from people within advisors and stuff like that, because I will poke them when they needed to be poked for the benefit of consumers widely. So I get a lot of flack. So it's good when the army of Money to the Masses listeners and fans go and praise us and stick up for us. But Omar had a question. He said, I have a question regarding tax, which I think is probably relevant to many other people. I have a small side hustle which essentially involves selling some products on Amazon and eBay. Currently I'm under my £1,000 trading allowance, but I'm hoping to bust through this next year, which means I will probably need to register for self-assessment. I'm currently employed full-time and a high rate taxpayer. What should be my next steps once I get to the point when I need to declare my income? Well, this is the exact point from Omar. If you get to that point, you're going to have to start putting money aside to pay the tax. That is the long and short of it. And you're going to have to therefore register for self-assessment. So when it gets round to the, you're going to have to declare your tax for that tax year, which will, don't forget, it will be the 31st of January the year after the tax year that you actually earned the money. You need to register for self-assessment so you actually pay the right amount of tax. So the trading allowance, if you don't know what it is, I've just explained it, but Google it. It's something which a lot of us could use to actually minimise our tax, but also it's quite a nice incentive to have an allowance like that, to think, do you know what, I can make money on the side without having to pay any more additional tax. And just to finish off that list, you can rent stuff out. There's apparently sites such as Fat Llama, which I have no experience of, allow you to rent out some of your possessions. That seems very interesting. Not sure I'd do that, but anyway. And another nice tax one is the marriage allowance, because don't forget, if you are a basic rate taxpayer and your spouse isn't using their tax-free allowance on their income, then you can they can actually donate 10% of it to you, which actually save you some tax. So have a look at that. Google marriage tax allowance, or marriage, it's actually marriage allowance. So Google that if you want to know more before you complete your tax return.
Excellent stuff. So we covered off sort of 3 pieces and then bolted on the extra trading allowance. So we covered the 2 investment pieces, then we did the how to make money, and we sort of segued into the trading allowance as well. So you mentioned something about a pension bit as well. Are we going to save that for another week?
We'll save that for another week, Andy. It was about how you'd invest. It was a question about how I would make an income from £100,000 savings, given the fact that I'm petrified of investment markets. Not me personally, the person who asked the question.
Well, there we go. We're not in the habit of doing spoilers, but yeah, tune in next week. We'll probably cover that off next week, I imagine.
We'll try to, unless I forget, which is something I often do. Don't forget to follow me on social media, because at the moment there's some really good stuff. We're doing a lot on social media now. Andy's joining us next month on Money to Masses, but Lauren has just joined us. And Lauren is a millennial, and she's brilliant at what she does. So go and have a look at our social media. It's so much fun on Instagram at the moment, the stuff we do. You can see much more of what goes on behind the scenes, the personality, and also we're sharing a lot of really good stuff on Instagram and Twitter. So I think if you don't follow us on those mediums, I think you're missing out on quite a bit, because there's stuff on there that you won't see on emails or on this show. So go and follow us. And the other thing is the Money MOT, what I talked about before Christmas. It's so close, Andy. It's almost here. I could touch it. So that is going to be something will be imminently launched, and I'll give you URLs and talk about it. We'll probably do a special show about it.
Excellent stuff. And of course, we've got Damien's midweek markets to enjoy, coming into your feed on a Wednesday before we come back again next week to talk more. So enjoy that. Damien, loved it, and I'll see you very soon. In fact, I can't wait to be working with you soon.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.